Now, I think inflation's been a big story, obviously, for fixed income since 2022. Inflation, by and large, across the globe is beginning to come towards central bank targets. But of course, we have a lot of different events that go on that influence inflation. We've just had an election in the US. The new Trump administration is expected to be inflationary or maybe reflationary. In particular, obviously, the potential for tariffs around the world will probably drive prices slightly higher. I think the same could be said here in the UK. We've just had a budget from the new Labour government, which again is seen as being slightly inflationary. Nevertheless, I don't think inflation is getting back to where it was in 2022, and it may pause, but will continue to come towards central bank targets. That may mean that the rate cutting cycle that we're now has just started could be a little bit slower and maybe a little bit delayed to what we would have expected a few months ago. Nevertheless, I think rate cuts are going to come through. However, a lot of that is priced into the market. So interest rates and yields are likely to stay higher than maybe investors would have expected just a few months ago. I think you can incorporate that we are incorporating that into our thinking in terms of being a little bit more cautious about having long-dated government bonds in particular, or long-dated investment-grade bonds. I'm not sure that we were going to get the same kind of capital gains that maybe would have expected, or the market was expecting just a few months ago.
The rates market has been extremely volatile over the past couple of years. As volatile pretty much as it has ever been outside of periods of crisis. So it has been very difficult to navigate, as investors are really struggling to adjust their interest rates expectations from one data set 1 month to the other. So that level of volatility has been very difficult to navigate for us and for global investors, because what happens in the interest rates market has an impact on all asset classes, because that level of interest rates is used to one extent or another as a discount mechanism to value any financial assets. So that period has been very difficult. And it is likely to remain relatively difficult as well. Now, with the re-election of Donald Trump as US president, there are concerns that US deficit will increase, that the tariffs measures that he is likely to put in place are going to be inflationary, which is there again is going to create some upwards pressure on interest rates. The way we have navigated and will continue to navigate this environment. First of all, higher rates have allowed us to invest in fixed income assets for the first time in years, because the level of yields are extremely attractive. So we can use that source of diversification and returns in our portfolios. The other thing that we are doing is to stay diversified. Despite some high levels of valuations in pockets of particularly the equity markets, we continue to find lots of opportunities across asset classes and across regions in our portfolio. So we want to take advantage of those. But we recognize that we live in volatile, noisy environments. So it is important to stay diversified, to be nimble in our asset allocation, and to be very active in terms of take it profits when we have some, and to recycle those into the parts of the portfolio that haven't performed as well.